welcome back everyone to another episode of the Long Game Podcast. I'm your host, Thomas Kolbman, and here with me is Chad Huebsch again. So this will be the second episode that we've done together. If you didn't go back and listen to the last one, I would, because if you're a business owner, that's probably a little bit deeper, a little bit more impactful, talking about tax strategies for business owners. But today I'm going to have him on again, and we're talking about something that I don't think a lot of business owners know about. And I definitely think that because I know a lot of financial advisors don't even know about. And that's the difference between a stock and an asset sale. So as a business owner, when you go sell your business, it's going to be one of two ways, and the impact is going to be very different. So Chad, when you think about stock and asset sales, like how can you break it down for us or for the average business owner to understand kind of the differences?
Yeah, I'd consider, I mean, it probably is it's a large company, but like you could go out and buy Google stock. You could buy potentially enough and do like a hostile takeover. You would own Google. At that point,
Yep.
you're not creating a new business. You own the business. So if you sell your business in a stock sale, they are literally buying your legal entity as well as all the pros and cons. So all the assets you own, potentially all, in most cases, all the liabilities, um, stay with the company. You're buying those. Um, Whereas an asset sale, they're actually literally buying each individual asset, and in most cases, they don't buy all of the assets of the business. They buy a majority of them, but not all of them. With a stock sale, sellers usually love it because you're selling the stock of a company, which if you've held for more than a year qualifies for long-term capital gain treatment. So in most cases, you're in the 20% bucket. Whereas if you sell assets, and depending on the type of asset, you could be facing up to 37% federally plus state tax on that. So difference between 37 and 20, as you can imagine, most sellers want a stock sale when they go to sell their business.
So I think one question people would ask right away is like, well, why is the asset, if I've held the asset for greater than a year, why is the asset taxed at a higher rate?
Bingo. So there's several classes of assets, and so depending on the type. So the most common one is equipment. So you've taken depreciation on the equipment. Let's say you've owned it for 10 years, still working well, but there's no depreciation left. Well, just like if you were to go and sell it pre-sale or as part of the sale, you're selling it, you have that depreciation recapture, which is normally taxed at well, 25% in most cases, but there are some assets that are still taxed as ordinary income, like inventory and AR. Those ones are going to get picked up as ordinary income. And the majority of the business, in most cases, is you're still buying the goodwill. So, like, you have the hard assets, the tangible assets, and then everything else that gets you to the purchase price is usually assigned to goodwill. And the goodwill, in most cases, you can get long-term capital gain treatment. So it's not all lost. You're not going to pay a flat 37% on all of your assets if you do an asset sale. There's some
So
nuance there.
then what happens if I'm in doing a stock sale, but I have things I've depreciated?
Yeah, so that's a good point. So there's because you're buying the stock and you're not, or sorry, because you're selling the stock of the company and not the assets, that's what the tax treatment is. However, the buyer doesn't usually love a stock sale because if you have a fully depreciated asset, then they have a fully depreciated asset that they can't then depreciate. On the flip side, if you have an asset sale, you buy equipment, now you can start depreciating those again.
So where do you find most business sales are? Like, do you see in most business sales you have the buyer who's like, okay, asset, and then you have the sellers like, no, I want this to be a stock sale. How does this end up going?
Yeah, so and I've seen a lot of it in the private equity space. So private equity is coming in, they're going to do it be an asset sale. One of the things that it's important, and the people that are listening to this podcast will know, is that if they ask for it, then you can say, well, there's going to be this tax hit because I'm going to be selling the assets instead of the stock of the company. We need to account for that in the purchase price. And if you can ask that up front and pre-signing the LOI, you're going to be much better off negotiating that than if you're trying to bring it up at the 11th hour of like, oh shoot, I'm going to get, hammered with this tax bill.
That's smart. I mean, like, hey, if you want this to be better for you in this way, well, I'm going to ask for more money because the net I'm going to take home is way different.
Exactly. And you usually meet somewhere in the middle, but again, if you can, this is in most cases, in most cases that I've dealt with, this is their like last bite at the apple. This is the seller kind of in their twilight of their career. They're getting ready to sell. They're not going to go start another company, and so they want to be able to maximize how much after tax cash proceeds they get.
Okay. What type of businesses do you see fall more so? Let's go each side. Like, is there certain industries or type of businesses that you see more often get treatment as a stock sale?
Yeah, it's mostly companies that are software. So there's a ton of software companies that sell, and that's where that 1202 or qualified small business stock exemption comes in, as well as highly regulated industries. So contracts that are hard to assign, lots of fixed assets
Yeah,
with
like
equipment.
government contracts and stuff.
Exactly, exactly. Like I did one a few years ago now, but they basically ran a small town's um, trash like pickup. And so they had a small landfill, they had a bunch of equipment, and the buyer, which was a national player, came in
I
and
was
they were
gonna say
like,
that's how they all work, right?
yeah,
They basically there's little ones and they always get bought, and there's like these like 2 to 3 big ones that just all they do is M&A.
exactly. And so that was the case there, and they didn't want to reassign the thousands of assets individually and the contracts with the municipality, so they did the stock sale on that.
Okay. And then where do you see most businesses that end up doing asset sales?
Asset sales, again, private equity wants to be able to pick up those deductions, so they're going to want to be able to do an asset sale. Um, and that's the big benefit is that they get the step up in basis. And so it's really anything else that doesn't fall in my experience, software or those highly regulated industries.
So what about like professional services businesses? So you'll see CPA firms, you'll see financial advisory firms, like they will sell, and their only asset typically really is their clients.
Yeah, the client list. So in most cases, and this veers into some non-tax things, but when you buy the stock of a company, you're buying all the good, the bad, and the ugly. So if there's a lawsuit coming, and they should disclose that, but if there's a lawsuit, it's yours to deal with. Whereas if you're buying an asset sale, there's usually better protections there. Obligatory attorney comment as I talk about those things. So yeah, I would say most of them are going to be asset sales for those professional service companies because the buyer wants to be able to get the goodwill deduction, and that's a 15-year deduction, so it's not going to be a windfall in year one, but it's going to last for the lifetime of it, and you can usually negotiate around price.
Okay. Let's talk a little bit more about the goodwill deduction.
Yeah, so and this is both sides. So the buyer and the seller in the asset sale have to agree on the value of these different asset types, and I think there's seven. So the purchase price allocation is a term you'll become very familiar with. And so you can't have the seller saying that there's no value assigned to this equipment, and then the buyer saying 90% of the value is assigned to the equipment. That way we get better tax treatments on both sides. You both have to file together.
This is why these negotiations are so long, right? Like I prep all my
Exactly.
business owners like this is not an easy sale. It's not like guy wants to buy your business for 2 million bucks, shake hands, do it. It's like negotiations take forever. That falls through, you move to the next person. Like people feel like they spend 6 months to a year, full-time job is selling the business because all of these things have to be agreed upon.
It's a marathon, and I don't think a lot of people consider how long and the mental toll because you got to run your business still. In most cases, founders are still heavily involved. Plus, you have to deal with your attorney, the buyer, the buyer's attorney, your broker,
Your
all of that
contingent people in
stuff.
the background that you're keeping there just in case you need to go to them.
Exactly. And in most cases, the purchase price allocation, at least that I've dealt with, it's usually done 45 or 90 days post close. So there's a little bit of ambiguity for situations where, depending on the type of asset, we really push to get it done prior to closing so that there's a lot of certainty there. But um, recently, a lot of them have done like post close purchase price allocations.
Okay. So anyways, back to Goodwill.
Yes. So goodwill. So again, you buy a company, you're buying the cash, you're buying the AR if they're accrual, you're buying, the customer list, you're buying the equipment, the vehicles, etc. Everything else gets assigned to goodwill. And so if you've got a $10 million acquisition and there is $4 million of real assets on the balance sheet, 6 million is going to be assigned to goodwill. And again, that's favorable from the seller's perspective because that's what qualifies for long-term capital gain treatment. So the 20% instead of 37. And from the buyer's perspective, um, it's not the longest on the depreciation table, but from most acquisitions, it's 15 years. So you're going to be deducting whatever that $6 million over 15 years to do that.
Okay. Makes sense. What else do we need to talk about on this topic as it relates stock versus asset sales?
Yeah, so there's actually a hybrid version. It's called a 338H10 election, which basically says for legal purposes, it's a stock sale, but for tax purposes, we're going to treat it as an asset sale. Um, so you kind of get the best of both worlds, and it's mostly the buyers that are pushing for this because, again, in the kind of the sanitation uh, example, they had all these contracts that couldn't assign to a new legal entity, so that for legally they wanted to buy the entity, so they had all those things in place. But then for tax purposes, it's a stock sale. Again, negotiated usually upfront and with purchase price adjustment to account for the tax hit by converting it from a stock to an asset sale. It's only applicable in C or S corporations, so partnerships it's not allowed. But it's not very common, but there's a subset where it makes sense to do that. So that's a possibility
Interesting.
as
So
well.
one thing that you said earlier is that like they, a lot of times they like um, sell or no buyers like asset sales
Hmm.
because of step up in cost basis. But what you're talking about there is on the assets that are depreciable, right? Like it's not that like obviously the business, the what they bought, they have a cost basis of what they bought it for. But it's just the assets inside that would be depreciated so they can't further depreciate what they get.
Exactly. Yeah.
Right. Yeah. Because I think somebody would maybe think that and they'd be like, well, wait, well, if I sell this business now, I have the basis from what I bought from still.
Right. No, it really goes back to the form and nature of the transaction, stock versus
That's
asset.
why this stuff gets so confusing. There's just like so many levels, and yeah, this is why you don't go alone at a business
No.
sale or really plan for one alone either for those years in advance.
Exactly. And really if you're starting to plan for it, like make sure your financials are in order. Like if you've been kind of halving your bookkeeping, like get a solid bookkeeping solution in place. You want your financials to look good. Any seller who comes in who's just like, I can't understand these books, that's one less seller that's going to make an offer.
Yeah,
Or
I told this story maybe a couple of years ago, but I had a client I worked with that they had a family business and they like did not invest in financials. Like the financials were so bad they couldn't tell a story and they thought they were worth 80 million. They basically like started going through and they're like people are offering us $30 million. And they're like, okay, great. We're going to spend about 18 months working on our financials, getting everything back. We're going to go back to it. Business didn't change that much. They started getting offers for 60 million because people could actually understand the story, the growth, what's being depreciated, like, which you'd think at that size of business that they would already have that all kind of nailed down. But like, I see a lot of businesses with really, really, really messy financials and you're never going to get the value that you want from it when they can't trust your financials.
exactly. So it's usually, I'd say, get 3 years of good financials. Make sure that so this is a multi-year process. You don't want to flip the switch and say, I'm
And
going to
try to sell
sell.
after 3 years of good financials. If you have like a
Exactly.
bad year in there, you might want to push the time a little bit because they are really looking at those 3 years.
The trailing 3 years, and really the trailing 12 months, but the trailing 3 years. And for businesses that were hit hard during the pandemic, they usually waited, like you said, another year to get another year of financials under their belt.
Yep. Yep.
The the biggest planning opportunity that I've helped clients with around the sale of a business when it's a stock sale is the 1202 or the QSBS exemption, which again, you can exclude up to 100% of the capital gains. And with the stock sale, it's all capital gains as long as you've held it for a year. The rules around QSBS is that you have to hold the stock for 5 years. You get up to 10 million of exclusion or 10 times your basis. So if your basis is higher, it's the greater of, which in most cases with the tax laws, it's the lesser of the two. So this is
Yep.
super favorable. It has to be a C corp, which again, double taxation, you've got to deal with that, but you can you can go after this, in which most cases people do. It can't
If you're going
be,
to get 10 million, if you get
yeah,
10 million, there's just very, very few situations that the double taxation is going to put you in a worse spot.
exactly. Especially because it's stock, right? Because it's stock, there's no double tax there. Um, there are some disqualified industries, but most industries that are applicable are in the tech realm, would be
Yep.
applicable to that. Um, I I helped a client. This was 2 years ago now. That qualified for this. They didn't know, so their financial advisor brought me in, and they're like, "Hey, I know you do tax planning." They were a tax planning client themselves, and they reached out and they said, "I have a client who needs your help." And so I looked at the facts, and they qualified for this QSBS, and they saved like an additional 800,000 in tax,
Yeah.
which now again, they were like in their late 50s, they're getting ready to retire. That's another almost $1 million that they can have in their nest egg because of
So
it.
impactful. And I think, the planning around this one is think about C Corp, S Corp partnership early enough because when you move to C Corp, it has to be early enough in the business where you don't have over 50 million in assets.
Exactly.
But if you do it a little bit later, but 5 years and your basis is like a few million, right? It's 10 times. So there's people
Hmm.
who they'll move to C Corp and the basis could be 3 million or 4 million, or, they do a rollover into a new entity they're starting and basis is higher, right? So you can get 10x that. On top of that, like we have clients who leverage different trusts, right? This could be slats.
Hmm.
It could be, in different states, it could be the nings, the dings, all of those. They're just regular revocable trust. There are a lot of ways to stack this if you're very, very wealthy, right? Like if you're going to get 20 million, you might not put it, there are trusts that it can come back to you, but a lot of the trusts are, this is money that you're giving up.
Hmm.
But there's people who do a slat and then one for their children. And then, there's just so many ways
Charitable
to,
too. Yeah.
well, that's a good one on the sale too. Before the sale of donating part of your business,
Hmm.
right when you have a great valuation, you get the whole deduction against income, and then you avoid that capital gain.
Yeah, and the key there is it's all about planning. So you can't have an assigned LOI and be like, okay, now I'm going to set up this charitable trust, which is going to own a portion of the business and goes through with the sale. So
It's got to be before LOI.
yep, it's got to be with some foresight there. But depending on how you want to structure it and your needs in the near term, you could set up either like a charitable remainder trust, which again, the money doesn't come to you, so there's no tax hit. It goes directly into the trust. Um, the You'll receive income during like whatever the term is. It can be 10, 15, 20 years. And then whatever's left over at the end, the charity gets. So that's the charitable remainder trust. The charitable lead
And that one's
trust.
great for people who want money back.
Yes, exactly. So the charitable lead trust is the again, you can set the terms like as time horizon 10, 15, 20, 30 years. The charity receives payments each year up to that dollar amount, and then at the end, it comes back to you as the owner.
Yep. And for
So
both of these, like depending on how much you want back to you, depends on the deduction amount too, right? Like the more
exactly,
favorable for you, the less the amount you can deduct. But then you also can do donor advised funds as well.
exactly. I loved DAFs. They are, I think, underused in most cases. People go directly sometimes to these trusts, which have a time and a place. But if you're looking for something a little bit more streamlined, less costs, donor advised
Yeah,
funds
and if
look
you're
really
higher
good.
net worth and you're just like, hey, I'm retiring at 50 selling my business, I give 20K a year to charity. I want to cover the next 20 years on
Yeah.
my event with the lowest basis, highest capital gain.
Hmm.
That's where, these things start to make sense. Like cover that goal for the rest of your life. You can still grow it and use it, but lots of good planning.
Yeah. Other things on mostly with stock, but some asset sales will apply as well, is installment sale treatment, which basically means you get a down payment, you're going to pay tax on that down payment, and then the subsequent years you don't pay tax until you receive that money, and that's becoming fairly commonplace in most M&A
Yeah,
activity
nice
that
to
I'm
spread it
seeing.
out too, tax
Yeah,
wise.
yeah. The other thing to consider and to make sure the language is correct is earnouts. So in most cases, there's an earnout like, hey, you're going to stay on full time for 2, 3, whatever the year's terms are. And as long as you're hitting these goals, you're going to get an additional cut, a payment. If it's tied, if that additional payment is tied back to the purchase price, then again, you can usually get more favorable tax treatment. Whereas if it's like, hey, we're just going to pay you as an employee and you're going to get this $1 million bonus as an earnout, you're going to pay ordinary income tax on that. So just make sure you're cognizant of that and
Great point.
putting in the right bucket.
Great point. Okay, cool, man. Anything else you think we need to hit on for this topic?
No, I'll just hit on again LOIs. I can't tell you how many times a client has come to me with a signed LOI, and there's usually a lot less planning we can do at that point. So if you're starting to think about selling your business, that's when you should have these conversations with your financial advisor and tax
Yep.
advisor.
As early as possible was really the best advice. Exactly. Sweet, man. Well, appreciate you coming on. I feel like this is an episode that I've been needing to do for so long and just haven't had anybody even throw out the idea. So appreciate having you and the knowledge base that you brought. Everybody, again, go listen to the other episode Chad was on. If you're looking for just some tax advisor and person to work with, or if you're a financial advisor that doesn't do tax advising and needs a partner, Chad, very knowledgeable. I recommend him. But before we head out, Chad, best places to follow you.
Yep. So you can look at LinkedIn or Twitter/X. If you want to reach me directly, you can go to my website, which is bluetaxplan.com.
Love it. Love it. All right, everybody. Appreciate you listening. Again, remember to rate and subscribe, and we'll see you back next week.
That's good.